So if you're anywhere under the age of about 30, at this point you really haven't seen a prolonged market downturn in your entire working career. And even though we saw a big hit to the financial markets in the spring of 2020, this recession only lasted about 2 months in total and was followed by almost 2 years of huge growth in stocks, real estate, and even wages as interest rates fell to all-time lows. But today, with year-over-year inflation numbers clocking in at over 8% in each of the last 3 months, monetary policy has shifted in the complete opposite direction this year, with a tightening by the Fed and substantial interest rate increases already in 2022, which has led to a lot of fear around a sustained recession and stocks moving in to bear market territory. And when recessions do hit, there can be a lot of implications for commercial real estate specifically. And if you're working in the industry right now, or you're a commercial real estate investor trying to figure out your next moves, there are a few key things that you're going to want to be aware of heading into this type of environment. So to help you navigate what could be some pretty choppy waters over the next few months, in this video, let's talk through some of the most common commercial real estate trends that tend to play out during economic recessions and what seasoned real estate investors and private equity firms tend to do to manage risk and even profit during these times. So the National Bureau of Economic Research defines a recession as the significant decline in economic activity that is spread across the economy and that lasts more than a few months. And with the economic conditions that are playing out right now, rising interest rates will very likely lead to a decrease in consumer spending, which results in declining revenues for businesses, prompting these businesses to reduce costs to make up the difference, which often leads to job losses, lower incomes, higher unemployment, and an even more substantial drop in consumer spending overall. And when this plays out, all of these things can impact commercial real estate directly, since consumer spending affects everything from housing demand, travel patterns, and the demand for goods and services in almost every industry across the board. During recessions, owners of residential for-rent properties tend to see drops in occupancy and rents as people double up with roommates or move back in with family. Owners of retail properties tend to see lower sales numbers for tenants as consumers tighten their spending habits, and owners of office properties tend to struggle with vacancy and rent reductions as companies start to lay off workers, reduce their office footprint, or even fold completely and disappear from the market. So to mitigate these risks in recessionary environments, seasoned investors and private equity firms will often gravitate towards necessity-based real estate across all asset classes, which tends to outperform other types of real estate when market conditions soften. Grocery stores will continue to sell food, pharmacies will still provide patients with medications, and workforce housing will actually often see an uptick in demand from renters who may have otherwise been in the market for luxury Class A product, now trying to cut costs and reduce spending during these times. But aside from just demand from renters in the market, investor demand for commercial real estate also tends to shift in recessionary environments, and major sources of equity capital tend to get a lot more careful on the deals they choose to pursue. In most cases, investors with a long-term hold horizon that have bought real estate during almost any time period over the past decade have seen their investments perform extremely well during this time, and in many asset classes, there's an argument to be made that commercial real estate investors could have bought pretty much anything over the last 10 years and still made money. However, when spending is contracting and consumers are becoming more careful with their disposable incomes, major private equity firms, REITs, and family offices also tend to get a lot more selective with not only what they choose to invest in, but where they choose to park their capital. This is often referred to as a flight to quality in commercial real estate, where investors try to mitigate their risk by shifting their investment strategies to core gateway markets like New York, San Francisco, Chicago, Boston, and Los Angeles, all of which tend to be both densely populated and also have significant supply constraints, and as a result, often see less dramatic drops in demand than you might see in secondary or tertiary markets when the economy goes south. Oversupply is a huge concern during recessions, especially in areas which have traditionally been overbuilt during these times, and these often tend to be the markets with a lot of available raw land to build on and loose governmental policies around new construction and development. The record low cap rates we're seeing across the industry today only pencil out if you think we'll see sustained annual rent growth percentages at or near double digits, and this is especially true when interest rates on many fixed-rate commercial real estate loans right now are even higher than cap rates in most US markets. Ultimately, if demand doesn't continue to exceed supply at record levels, it's going to be pretty tough to sustain the kind of rent growth we've seen over the last 12 to 24 months in the cities that tend to be most susceptible to overbuilding, and rent and value reductions as a result of that tend to be secondary and tertiary markets. All of these factors generally lead to increased capital flows during recessions into gateway markets, usually concentrated on deals with low levels of leverage, strong credit tenants, and contractual in-place leases with significant term remaining, which creates boring but stable business plans that protect investor downside in multiple different ways. Now, if we do head into a recession, it's definitely not all doom and gloom here, and on a positive note, recessions also tend to create huge opportunities for well-capitalized investors that know how to both spot and take advantage of distressed assets in the market. Over the past few years, for most broadly marketed properties, huge buyer pools combined with extremely cheap financing have made it really difficult to find profitable deals in most markets across the country. However, if pricing starts to ease up for the reasons I mentioned earlier on in this video, this has the potential to create a huge buying opportunity, one like we really haven't seen in real estate since the Great Financial Crisis. Now, I'm definitely not saying that things will be as bad as they were in 2008, 2009, or 2010, but what I am saying is that there are very likely going to be deals to be had, especially from over-leveraged investors banking on double-digit rent growth that might not materialize. And even though we don't know for sure what's going to happen this time around, if we take a look at historical performance of real estate over the past 10 years, we can start to really quantify the potential opportunity of buying into the market when things feel their worst. And to make this more concrete, using a very basic example of single-family home values pulled from Zillow research data for properties purchased in March of 2012, which in many cities in the US was the bottom of the real estate market, investors in Miami have seen property values increase by 173% since that time. Investors in Atlanta have seen values increase by 185% since that time. Investors in Seattle have seen value increases of 205% since that time, and investors in Phoenix, Arizona have seen value growth of 244% from March of 2012 to May of 2022. And to put these numbers into perspective, assuming a standard residential loan of 80% of the purchase price or 20% down payment, a $40,000 investment made in 2012 in a property in Phoenix would now be worth $328,000, which represents an annualized rate of return of 23.4% or an 8.2x multiple on equity invested in the deal. These returns aren't even taking into account rental income that could have been generated during this time, and while single-family home values do paint a really clear picture of the opportunity here, value growth can come even faster and on a much bigger scale for investors in office, retail, and industrial properties. In recessionary environments, major office occupiers will often decide to downsize and vacate their spaces when leases are up for renewal. Major retailers will often struggle to make sales, with many going out of business and vacating their spaces unexpectedly, and major industrial occupiers can also often decide to reduce their footprint during these times, as consumer demand for goods that are stored in their warehouses will often decline in a very big way. And when these things happen and a new new investor can come in and take over a struggling commercial property at 50%, 25%, or even 0% occupancy in many cases just by signing 1 or 2 long-term commercial leases. Well-capitalized investors that can pay for the upfront leasing costs that are necessary to turn the property around can often bring occupancy back up to levels at or near 100% in just a 3 to 6 month period, which can sometimes double or even triple the property's NOI, which can often double or triple the property value as a result. The bottom line here is that distress creates opportunities in commercial real estate, and if you're watching this video right now and you have entrepreneurial goals, the next 6 to 12 months could turn out to be a really unique buying opportunity that you might not see again for another decade or more. And if you want to learn more about the underwriting and analysis process and how to spot commercial real estate investment opportunities regardless of market conditions, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, retail, and mixed-use deals. And you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on the current state of the commercial real estate market, make sure to hit the like button to let me know, and let me know in the comments where you think the commercial real estate market is headed right now for the rest of 2022. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.